everybody want to get a deal. So you got to get a deal when you are investing in real estate. Like, listen, we don't pay retail for anything, meaning that you got to buy it at a good price. So when it's time for you to sell, you make money. And so the ARV definitely involves, looking at properties that have sold within the last 3 to 6 months. That's important because that shows you right in that general area what properties are selling for. Today, what we're going to talk about is how to understand the 70% ARV rule. You're going to hear me talk about this a lot. I know that some students that have been in the program for a while now, they probably tired of hearing ARV, probably dreaming about ARV, like AARP. No, we talking about ARV. ARV is important when it comes to real estate investing. It's extremely important. It's really what the lenders, the banks, hard money lenders, commercial lenders, it's what they really look at, the ARV, and their magic number is 70 of the ARV. So they're only going to finance 70% of the ARV, and ARV stands for after repaired value. So really, it's just a fancy name for market value. When a property is totally renovated in tip-top condition, that's the after repaired value, right? It's synonymous with the word market, market price, right? So anytime somebody might say, hey, what's the market price of this property? Really, they're saying, the ARV. And we're talking about properties with ARV. We're talking about a property that's fixed up, not just any old property that doesn't have any repairs. That's why the wording is there, after repaired value. So it's mainly used because they know that you're going to be improving a house. They know that you're going to be getting a house, and it's probably a beat up house, and you're going to be fixing it up. So the lenders know that, but this is the language that the lenders understand. 70% of the ARV. Lenders only, most of them, majority of them really only like to loan up to 70% of the ARV. You got some that'll go a little higher, but especially when you're newer, their comfort zone is 70% ARV or lower, right? So by you knowing that, you know that any deal that you get is going to be in your best interest to get it at 70% ARV or less, 70% ARV or less. So put a little example right here, right? So like I said, stands for after repaired value. And one thing that, I use it for is when I'm doing the BRRRR method. The BRRRR method is the buy, rehab, rent, refinance, and repeat. And so that is a core foundation of our program is the BRRRR method, where you get the property, you fix it up, you rent it out, you refinance it, and you repeat that. Is this rinse and repeat, right? That's how you build a portfolio. That's how you get your construction, your renovation and investment experience under your belt. This is how you do it, right? So ARV and the BRRRR method is very important. So this is an example of how, say, ARV gone wrong. So an investor, say they want to buy a fixer upper and they paid $150,000, then they spend $50,000 on, but the ARV is 190. If the ARV is only 190 and they spent 150 for the property and 50,000 for the repairs, they lost money. They lost money. And this is a simple example, right? So it only looks like you lost $10,000, but there's a lot more moving pieces in there. So you would lose more than $10,000. So you definitely want to understand how ARV works. You want to understand how to calculate it, right? And so basically, the main principle of ARV is you take a property, right? And I'm gonna actually do an example. Let's see here. It was this property here just came across my desk, 1600 Belmar Drive. This is in Gastonia, right outside of Charlotte, North Carolina. So this property came across my desk, and the wholesaler is asking, let me see, what are they asking for this? They are asking 153,000 is what they want, right? And so they say they want 153,000. So we have to figure out if their number, that 153,000, is more than 70% of the after repair value, right? So it's a little bit of reverse engineering. So one thing that you can do is, if you look in yourself, you can use Zillow. Zillow is a good place to start, right? I'll say Zillow, you know, give or take, they probably get it right about 75% of the time, but it'll at least give you a ballpark and give you an idea of what a property is worth. So they're saying this property is worth 220 with this estimate. So when you go to Zillow, look up the particular property, you can scroll down and see like similar houses that have sold. So this house right here is it is about 1,215 square feet, 3 bedrooms, 2 baths, 1,215 square feet. So these are comparable properties that Zillow has in their system. So this property, 3 bedroom, 2 baths, 1,200 square feet, sold for 248. This one is 3 bedroom, 2 baths, sold for 200,000. This one is 3 bedrooms, 2 baths, and it's sold for 289. One thing I like about all of these, they're all very similar in size. So this gives me, you know, a good picture of the values. I think that this is pretty close between 1, 2, and 3, because this property is 1,200 square feet. This one is 1,200 square feet. This one is 1,200 square feet. And so is ours. So we would just click on here, look at the pictures now. So we're looking for properties that have been renovated. Like, yeah, so this is a good one. This property has been completely renovated. I can tell here. Nice renovation, new flooring, new paint, beams in the ceiling, new kitchen, recessed lights, nice stainless steel appliances. And I say new cabinets, probably some nice countertops here. Yep. Yep, nice countertop. So this property has been renovated. So this is a really good comp, right? So looking at this, so we see this property sold for 248. So this is a good one. 248. So that's a good one. Let's see about the next property here. So basically, we're just trying to get an idea if oh, they switched up on me. We're trying to get an idea if these properties, here we go, if these properties are similar in condition. We're trying to see if they've been renovated. So this one for 200,000. I'm thinking it hasn't been fully renovated, but let's see. Yeah, I was right. So, this wouldn't be a strong comparison per se, but this does give you an idea, because this tells you that a property that's not even fully renovated, this is just nice property that's been taken care of, but it hasn't been renovated. And this one here sold for 200,000, right? So that's really good right there. But that first one that I looked at, that's a really good one. And I'll see what this third one. I see this third one is somewhere in I think that was like 289. 289. Let's see what this is all about. So basically, what I'm doing here is just really trying to get an idea for what is sold. Uh, when you're investing and when you're going to the bank to get loans for these properties, and when you're trying to sell them, everybody's going to be comparing the house to other properties that are similar to it. So all of this is seems a little redundant, but you have to do that. You have to look at the competition. So this one right here is a nice renovation, full renovation. Looks like they got new windows, new flooring, new kitchen countertops, stainless steel. Uh, nice renovation, nice countertops, good layout. So all of these were 1,200 square feet, and so based upon that, Zillow is saying this property is in worth the neighborhood of $220,000, right? They even say 203 to 236. I think it's closer to this first one, but I'll be a little conservative, because the thing is this. when you are looking at properties, there's no benefit for you to overshoot, right? I know that most investors, not most newer investors, they'll look at these three and they'll automatically look at the one that's 289. They're like, oh, 289, that's what it's worth, right? Mm-mm. You at least want to go in the middle of these three, right? This one wasn't renovated. Excuse me, this one wasn't renovated. This one was, and this one was here. So I wouldn't hang my hat on the higher number. So we're gonna say 240, right? So I'm gonna take and say this property that we're looking at after it's fixed up, it would be worth $240,000. So we want to say 240,000 times 0.7 is $168,000. So that is the most we should pay for it, right? So 70 cents on the dollar, or 70% of the ARV, is the most that we should pay for it. Like that is like the ceiling, to be honest, right? In this market, you really want to get in closer to about, 60, 65%, unless it's just like a home run deal, easy cosmetic flip or whatever. Otherwise, you want to be really trying to get it lower than that 70 cents on the dollar. But that 70 cents on the dollar is a guideline, because that's where the bank is going to look, and that's the most that the bank is going to loan you. So the bottom line is, if you were to get the property under contract and you got the property cheaper than 70 cents on the dollar, the bank will actually fund the 70 cents on the dollar, up to 70%, and the repairs. So for instance, this one right here is, we did the math. We said 70% of 240,000. We say that was 168,000. Excuse me. This wholesaler This wholesaler is asking 153,000, right? So 153,000 is not a bad price when you're looking at this 70% ARV. As a matter of fact, you can do a little bit of reverse engineering. So you can take that number that they're asking, 153,000, divided by the number that we said the ARV would be 240,000. And that's like 63 cents on the dollar, right? So that's even better. So the ARV, it's always important to be at least 70 cents on the dollar or less. So basically, like I said, the bank will fund your loan up to 70%. So if you get it cheaper, right, the bank will fund your loan with the purchase of the property and your repairs. So let's just say I'm going to use like some real simple math. They said they want 153,000, 153,000, and you had 168,000 was 70% ARV. So the bank would actually loan up to 168,000, right? So that's a difference of, let's see here, that's a difference of $15,000. That being said, the bank will actually fund purchase price of $153,000, and they'll fund up to $15,000 of the repairs, because now you're still at 70 cents on the dollar. So they'll fund up to $15,000 of the repairs, So that is a game changer, because I think a lot of people think about, hey, okay, I got to buy the property, then I got to figure out how to get all the money for the repairs. Well, if you negotiate a good purchase price, the bank is going to fund the repairs now. So even if you bought the property like super duper cheap, let's just say you bought it for $120,000, the bank is always still going to make you put 10% of the purchase price up at that point. They're like, hey, look, you got to have some skin in the game. We know you got a great deal, but you got to have some skin in the game, right? But the point I'm making here is, you can get the repairs financed and the purchase finance up to 70%, 70 cents on the dollar. So that's why that number is super important. 70% of the ARV is like your guideline, right? So if you pick up a deal and you try to go to a bank and fund it, and it's not, 70% ARV, if it's higher, then, you're basically going to be setting yourself up, because what's going to happen is the bank is going to say, hey, oh yeah, we can do it. We're going to do it up to 70%. So anything above that, you'd have to basically bring additional money to the table because they're not going to fund anything above 70 cents on the dollar. So that's why 70 cents on the dollar is always super duper important, right? And so, like I said, Zillow is a good place to start if you're working with an agent. An agent can really go into the MLS and look. And I know we do have some agents that are part of the coaching program. So you already know, like as agents, you got access to more information. But for the individuals that aren't agents, an agent is a good resource because they have access to the MLS and they can go in and look at the numbers, right? So with this particular one, doing pretty much the same thing as what Zillow is doing, but I can just get a little bit more particular in the MLS. So what I did is I plugged it in the map to say, any properties that's within a half a mile, a 0.42 miles or less. So that's it's close proximity to the property and then very similar to the property. So I put 13 to 1800 square feet just as a guideline, right? Just to kind of, give me some leeway and see what's sold. And so it's very similar thing. Zillow has already kind of done all the work with the algorithm. This is how you do it. An agent would do it manually. So let's see what we come up with. So this is a house here, 265 it sold for. It's a little bigger, 1400 square feet. Then you got the same house. Well, no, I don't know if this one came up. Now, so this is no, it didn't because we look at a sold property. So this is a property that's under contract. It's been on the market, it's under contract. Now, and I want to show you something. So if you look, this is let me move the screen down some. As you look, this address here is 1600 Belmar Drive. That's the subject property. When we say subject property, that's the property that we're looking at. And while we're here, I just want to look at something right quick. So this property is not a bad property. It doesn't even need a lot of work. Like this roof looks newer, the windows look newer. So those are a big ticket item. So that's not bad. The roof newer, the windows are newer. So we're in here. Yep, yep. Looking at this. So it's not in bad shape at all. Yeah. So the renovation wouldn't be too bad. So it's not a huge undertaking. But this is on 1600 Belmar. Well, this other comp here, this other comp here is on the same street. It's on the same street as 2017 Belmar, right? So that's really good. And this property is listed for $253,000. It's a little bigger. It's 1,500 square feet, a little bigger, but it's listed for $253,000. So the reason why it didn't show up in Zillow because it hasn't sold yet, but it's under contract and it went under contract after like 17 days on the market. So that's good. That tells you that that price in this range is a decent price. We don't know, it might close lower, but at least we know that at 253 this property went under contract. And this property, I'm sure it's not totally renovated. Let's see what kind of condition is in. It might be. No, nope. It's just a well-maintained property. So that tells you a lot. That's good. That's good that you got a property that is not even fixed up on the same street and is listed for 253 and it's under contract, meaning that somebody saw enough value in that price range. We don't know what it's going to close for. It might close lower, it might close higher. My guess is going to close a little lower. But I think it's still very close to that number that we looked at on Zillow, 248,000. Let's see the other property surrounding it. This is another one. This was it's listed, still on the market, hasn't sold. It was 305 is what it's listed at, right? So I'm really hanging my hat on this one here. I think this gives us very similar numbers. This 253, which is going to probably sell a little lower, and then we saw the other property that was fixed up, and it sold for 248. So I think easily the property fixed up could sell, anywhere. I like to be conservative, anywhere from 240 to 250. Well, I would say 240 just to play it safe. Because think about it, you know, 240, you pretty much probably going to hit that mark. But if you get anything higher, that's just icing on the cake, right? So I think that is a easily 240 price. So just to recap, ARV is after repair value, and we always want to kind of look at 70% of the after repair value. That's our top. 70% is the top, right? So everybody want to get a deal. So you got to get a deal when you are investing in real estate. Like, listen, we don't pay retail for anything in investing. The whole adage where you make money when you buy, that's true, right? Meaning that you got to buy it at a good price. So when it's time for you to sell, you make money. So technically, you make money when you buy because you're buying it at the right price, right? And so the ARV definitely involves, looking at properties that have sold within the last 3 to 6 months, or within like really the less radius, like the closer it is to, the subject property, the comps, the comparables, that's important because that shows you right in that general area what properties are selling for. So that's super, super important. So this is, we talked about the 70% rule. So this is a little illustration, right? Where I told you, like, if you had a property for $300,000, the 70% of the ARV would be $210,000. We talking estimated repairs is 40,000. Strong, strong offer on a situation like this, a good deal. If you got this property for 170, that would be a good deal because that would put you at, let's do the percentage on here at 170. That would put you at like 56 cents on the dollar. So those are good margins there. You can make money, meaning with this example here, you are taking a property that after repair to be worth 300. We already know that the bank will lend up to 210,000, so that's even sweeter. So if you got it for $170,000, the bank will basically fund the repairs and the purchase, right? Uh, but you'll have to come to the table with like 17 grand because they want you to have at least 10% skin in the game, right? So the cheaper you get the property, everything works out better. Your margins, as far as like what your profit margins could be, also what your bank will lend on it. So it's important, it's extremely important to buy it at the right price. One thing I always say is we don't buy properties that are for sale. We only buy properties that are on sale. So remember that. Remember that for sure. These are some common pitfalls. I already mentioned kind of overestimating the market, right? Overestimating the market, meaning that you know, if people, you don't want to over improve it. Like you don't want to, we just looked at those pictures of those particular properties and we kind of seeing what those renovations are, right? So you don't want to overdo it, right? This illustration says you putting a gold plated toilet in a property. So just jokingly, but you don't want to overdo it. A lot of times it's hard to separate from, you know, something that you wouldn't do for your own house, and so you got to just understand, like, it's not about, what you would do in your own house. Your house may be in a whole nother price point, just may be in a whole nother category, right? You want to keep things simple. You want to do a nice renovation, but you don't want to over improve. Another thing is, just because a property is sold, let's say if a property took 12 months to sell, you're going to lose money because you got holding costs. Holding costs, you got your mortgage on the property, you'll have utilities you got to pay, you'll have attorney fees you'll have to pay once you sell it. You got property taxes, you got maintenance, like landscaping and so forth. So if you held the property for over 12 months, just because you thought it was a good deal, you got to know the timing too. You got to know that's where being plugged into our program and being connected to, good agents will let you know they'll say, hey, look, you don't want to really buy this property. They're taking 12 months to sell, right? If a property takes 12 months to sell, like forget about it. Like you're going to lose your shirt on that. So we're really looking for properties that are selling, every market is a little different, but I would say in 60 days or less would be your ideal type of property to look for, that's selling in 60 days or less. And then last but not least, emotional math. Investors often force the ARV. So that's what I was saying. Like, don't try to force the ARV. You want to be as conservative as possible, right? You don't want to overshoot. You want to say that, like, I look at that property. We saw one property that sold for 289. I could have hung my hat on that one, right? But that means that everything needs to go right. Everything needs to hit on all cylinders for me to get that top number, right? I'm going to be conservative and go with the 240, right? Because that means that I can still list it for the higher price, right? So if I list it for the higher price and I get more money, that's even better, right? But when you're looking at your deals, be conservative in your numbers and be realistic. Don't just, you know, cherry pick what we call it, the highest price property. You say, oh, this property sold for 289. I mean, as sellers in general, you know, as an agent working with sellers, I encounter that all the time, right? You'll have several houses that have sold in the neighborhood. And when I go to a seller's house, they're going to point out the one that sold for the most, right? Their next door neighbor house, they go right past that one that just sold because the neighbors down the street sold for higher. So I'm just saying, like, don't be like that seller. Be realistic and know that, hey, these are your numbers. So knowing your numbers are important. So that's a wrap for ARV, understanding the ARV and 70% on the dollar. Thanks for tuning in, Wealth Builders. I'll be dropping new content every week, so make sure you subscribe and click that notification bell. I'll see you on the next one.